Here is a situation that plays out somewhere in America every single day. A contractor wins the biggest job of their career. Genuinely good news. And then the arithmetic arrives. Materials up front, crew on payroll from week 1, payment 90 days after completion. The work is profitable, the client is solid, and the business still cannot say yes because the money arrives 4 months after it is needed. Welcome back to the Next Biz Thing. I am Markus J. Diplama, and this is the show where I look at businesses solving problems that matter more than they get credit for. Today we are talking about small business finance, and specifically about a New York-based lender called King Capital. Let me set the stage, because the timing problem I just described is the whole reason this category exists. Small businesses do not usually fail because the idea was wrong. A great many of them run into trouble because money goes out before money comes in, and the gap between those two moments is wider than the bank account can absorb. Inventory before sales, payroll before invoicing, equipment before the contract it unlocks. Every growing business lives inside that gap, and growth actually makes it wider, not narrower, because growth means buying more before you collect more. Traditional lending has never been especially well suited to that problem, not because banks are villains, but because their model is built around a long look backward, years of filed accounts, collateral, personal guarantees, a process measured in weeks or months. That works for a mature business making a considered capital decision. It works considerably less well for a restaurant that needs a walk-in freezer replaced this week, or a logistics operator who needs to cover fuel and drivers on a contract that starts Monday. That mismatch is what alternative lending grew up to serve, and King Capital sits squarely in it. They describe themselves as America's fastest funds for small business, and they operate out of 45 Broadway in Manhattan, serving small businesses and startups across the United States. What I find worth examining is not the tagline but the product range, because the range tells you how they actually think about the problem. There are 6 financing products, and each one maps to a different shape of the same underlying squeeze. First, revenue-based financing, where repayments adjust with cash flow. That structure matters enormously for seasonal businesses. A landscaper in February and a landscaper in June are financially different companies. A fixed monthly payment ignores that. A repayment that flexes with revenue does not. Second, invoice or receivables financing. This is the contractor's problem I opened with, addressed directly. You have done the work, you have issued the invoice, the client is good for it, and you are simply waiting. Invoice financing converts that waiting into working capital now. Third, equipment financing. Putzing, available up to the full value of the equipment. The neat thing about equipment lending is that the asset and the loan are the same object, which is why it can often be structured more simply than general borrowing. Fourth, business term loans aimed at expansion and larger investments. This is the conventional shape when a business has a defined project and a defined horizon. Fifth, business lines of credit, with interest-only payments on the amount actually drawn. A line of credit is a fundamentally different instrument from a loan. A loan is for something specific. A line is for uncertainty. It sits there unused and costs little, and it is available the week a machine breaks or an opportunity appears. And sixth, SBA loans, which carry a government backing that typically allows for longer terms and different pricing than purely private lending. Look at that list as a whole and something becomes clear. This is not one product dressed 6 ways. Those are 6 genuinely different instruments, and a business that needs a line of credit is in a different situation from one that needs equipment finance. Offering the range means the conversation can start with what the business actually needs rather than with what the lender happens to sell. The industries they serve line up with the pattern too. Construction and contractors, where the invoice gap is at its most brutal. Healthcare practices, with expensive equipment and slow insurance reimbursement. Restaurants with thin margins, seasonal swings, and equipment that fails at the worst possible moment. Logistics, where fuel and payroll run ahead of settlement. And wholesalers who must buy inventory before they sell it. That is not a random spread of sectors. Every one of them is a business where the money genuinely does move out before it moves in. Now, on speed, King Capital advertises approvals in as little as 2 hours, states that over 95% of applications receive approval in that window, and offers funding up to $2 million. They also describe their approach as no broker fees, no collateral, no runaround, and they emphasize looking at business performance rather than requiring personal assets or personal guarantees. I want to talk about why speed matters here, because it is easy to dismiss as a marketing claim. In small business finance, speed is not a convenience feature. It is frequently the entire value. An opportunity that requires an answer this week is worth nothing if the answer arrives in 6 weeks. The freezer that broke on Friday needs replacing before Monday service. Speed is not about impatience. It is about whether the money can still do the job by the time it arrives. The point about personal collateral and personal guarantees is worth its own moment too. In traditional lending, the founder's house is frequently part of the conversation. Being assessed on business performance rather than personal assets changes who can access capital at all. A founder without significant personal equity is not necessarily a worse credit risk. They are frequently just younger or newer, or from a background where property was never on the table. Their customers describe the experience in fairly unglamorous terms, which I always take as a good sign in financial services. Simple and straightforward, quick approval and seamless transaction. One client mentioned coming back across 8 separate loans. That last detail is the one I would pay attention to. Anyone can win a first transaction with a good rate and a friendly call. 8 is a different signal entirely. 8 means the terms held up, the process stayed painless, and the relationship was worth repeating. Now let me say something that belongs in any honest conversation about this category. And I say it as someone who is not a financial advisor and is not giving you advice. Speed and flexibility in lending are real benefits, and they come with a structure and a cost that is different from a traditional bank loan. Anyone considering any financing should read the terms carefully, understand the total cost and the repayment mechanics, compare options, and where the amount is meaningful, run it past their accountant. That is not a knock on this business or any other. It is simply what taking on capital responsibly looks like, and a good lender will expect you to do it. So why does this business matter beyond the specific companies it funds? Because small businesses are where most people actually work, and access to working capital is one of the quietest determinants of whether they survive their own growth. When a good business cannot bridge a 90-day gap, it does not merely miss one contract. It stops hiring. It turns down the next opportunity. Sometimes it closes while still profitable on paper, which is one of the more frustrating ways for a company to end. There is also a broader shift here worth naming. Credit assessment is moving from a backward-looking exercise to a present tense one. The old question was, what have you accumulated? The emerging question is, what is your business actually doing right now? Revenue-based financing is that shift made concrete. Repayment tied to performance rather than to a calendar that knows nothing about your season. That change opens the door to businesses that were previously invisible to lending. The 3-year-old company with strong revenue and no property. The founder whose personal balance sheet says nothing useful about their operation. Those businesses were not bad risks. They were simply illegible to a system designed around a different set of questions. So if you run a business in construction, contracting, healthcare, food service, logistics, or wholesale, and you have been staring at a gap between what you can do and what you can currently fund, King Capital is worth a look. Go and read through their 6 products, work out which shape actually matches your situation, and have a conversation. Ask the direct questions. Total cost, repayment structure, what happens in a slow month? A good lender will answer all 3 without flinching. That is the episode. Thank you for spending this time with me. If you know a business owner currently turning down work they could absolutely deliver, this one is for them. I have been Markus J. Diplama, and this has been the Next Biz Thing. Until next time, keep an eye out for the ones building something worth building.